The second half is 16, end of audit. And the reason we're doing that is because a lot of the procedures are at the end of the audit. So we kind of, the more theoretical stuff is in this one, in this class. And excuse me, just so you know, if you go on to accounting, the graduate class, auditing 433, we actually go into the different accounts. I think it's a little more interesting. For instance, auditing cash, auditing accounts receivable, auditing inventory. What are the actual audit steps for those classes? It's a little bit more, I don't say exciting, but it's more interesting than kind of going over, it's this, but not that, kind of the rules stuff. We're actually doing it. So, I don't know. I've often wondered whether we should switch those and have the nuts and bolts class be the first one and then the theoretical one be the second one, but they don't usually do that. Okay, let's go ahead and jump into the handout. Now, I did send out a new handout to chapter 7 that was not the one that was listed online. So you should have one that says Internal Control 2026. And I apologize if you printed that out from the 2025 one. I don't think I sent that out, but it was in Blackboard. But if the new one, it cut down the number of handouts from 1 to 2 or 2 to 1. And anyway, okay. Let me go ahead and get back to this one. And this is the first part here is the first handout that we cut out of. The Foreign Corrupt Practices Act. This is the first time in the U.S. history that the government got involved and said, this is something you have to have. This is something that, we're going to put some kind of a controls on this. It's not the Securities and Exchange Commission, but we're going to put these controls on this, on your companies and your businesses. And this is kind of the first shot was this Foreign Corrupt Practices Act. And it came about because of some things that companies were doing to make sales to foreign governments. And they were bribing officials and things like that. And oftentimes these contracts were somewhat unfair, but they would get these government officials to sign them because they give them a pile of money, or even what was a pile of money to that wasn't always to the companies. A company can come up with $2 or $3 million, no problem. Whereas a lot of these other governments and that, they were cash strapped. They couldn't, you wouldn't see that kind of money, and yet here it was, someone trying to hand it to you. So, Foreign Corrupt Practices Act, they brought all these CEOs into Congress, and they said, here you bribe this person and that person and this, this government official and all this. And they all said the same thing. Well, I had no idea that was going on. I'll look into it. I had, this is the first time I'm hearing this, and boy, if I knew it was going on, I would have really, we would have put an end to it right away. They all did the same thing. And so that's when this act came to be. It was, well, we have to have this act here so that we don't keep doing this, and it is somewhat controversial. I'll talk about that at the end of it. But so the whole idea is there was a problem, and that's when laws come about. Laws only come about when there's a problem. If there's no problem, there's no law. You have dog leash laws. You have to have a dog on a leash. Why? Because dogs, if you don't have on a leash, they run out and bite people. But they don't have any leash laws for things like rhinos. A rhino is far more dangerous than a dog, but no one ever walks a rhino, so why have a law about it? So, laws only come about for things that there are problems, and this was a problem that U.S. companies were bribing foreign governments and and really being unfair with they're dealing with these countries. Okay, and the big thing was, and this is where it comes into this class. It basically said that businesses had to have adequate internal controls. It was a requirement by law, and you could get fined for not having them. So you had to have adequate internal controls, and we'll see why in a minute. But anyway, so this is the Foreign Corrupt Practices Act, and we're going to kind of look at it. And again, this is to try to keep companies from bribing foreign government officials. Right? Who does it apply to? U.S. businesses and something looks funny here. U.S. businesses and foreign companies who do business within the United States. So this is one of those things that kind of is a little bit controversial in that if you're doing business in the United States, you must comply with this. Okay. And what's it talk about? It talks about bribing foreign government officials. That's what this whole act is about. Companies were doing it, and Congress said, knock it off. Now, to be a bribe, it must be voluntarily and intentionally used to induce the misuse of someone in their government official position. Now, there are a few little wiggle rooms here. And some countries, they have what they call grease payments. And these are payments that just are basically must be made to get something that should be done for free, but sometimes isn't. And a lot of times these are government officials. A lot of times it's so routine that it's, no one thinks about it even really. But for instance, sometimes getting stuff unloaded into a country, like off the docks and things like that, importing things, a lot of times the government officials will sell the forms. You got to complete this form. Oh, where's the form? Well, you got to buy it. $20 or whatever it is. You got to buy the form. So, it's one of those things that it's a custom, and you're not going to change it. So a lot of times, but these are usually small amounts. These are not usually in, trying to get a government official to do something outside of what they do normally. This is a lot of times these are things that are kind of ingrained in it. That yeah, you're gonna have to pay somebody a little bit to get this. And if you don't, you might have $500,000 worth of stuff sitting on a ship, that you can't get off because of a $20 document. It also is not for transactions that are between businesses. So if it's not a government agency, you can do whatever you want. Well, not whatever you want, but if it's not a government agency, it's not covered by this act. So we're not talking about people who are, a president of a company. We're talking about people who are, government officials, finance ministers, people like that. Okay, so this is what it kind of covers as far as the transactions. And what does it say we have to do? I have adequate accounting and controls are required by the act. So no more of this, gee, we don't know. I mean, if I had known, I would have done. A big, big part of this law is this. Why aren't you? Yeah. Come on, you. There we go. All transactions are deemed as being legally authorized by the business. And what that is saying is that you cannot play ignorant. You can't say, gee, I didn't know. Even if you don't know, that defense has been taken away. It might be that you're president of the company and you don't know what's going on, or the CEO, whatever. It is possible that you honestly don't know, but that defense is not available. And part of the reason it's not available is because what they saw in Congress. Everyone came up and said, "Yeah, I didn't know that was going on. Well, I'll take care of it." That kind of thing. So they don't allow that to happen. They don't allow you that. I didn't know what was going on. You're required by law to have an internal control system and accounting system adequate enough so that you do know what's going on. And if you don't have that, you're in violation of the law. So it's takes out that idea of that we can deny it. So issuers must have accounting systems and internal controls to ensure all asset transactions are recorded. These are people that are directly under the federal government. Non-issuers are prohibited from knowingly altering our accounting records or circumventing internal controls. Okay, let's go through some of these and see how they work. Let's try that again. I'm gonna unbold this one. Okay, what should I do? I'll make it I'll leave it actually. You want to just do that one bold? Nope. Oh, I know. Oh, there we go. Okay. A US-based corporation sells paper goods to the government Alpha. ABC Corporation also offers full tuition and board scholarships to the relatives of the government of Alpha. Is this transaction in violation of the Foreign Corrupt Practices Act?
Yes.
Yep. In violation of it. It is given to government officials. It's obviously a benefit to them. It has a value to them. And yeah, that is in violation of it. Let's go to the second one. US-based corporation bribes a government official in the country of Alpha for exclusive business contracts. The president of ABC states that the company had no knowledge of the bribery and it was perpetrated by a rogue employee. Is this in violation of the Foreign Corrupt Practices Act? What do you think?
Yes.
Yeah, part of the act is that you cannot claim you didn't know. You're legally, all your transactions are deemed to be legally authorized. So legal-wise, they're authorized. Now, you need to have an internal control system that can actually monitor that. So even if if you were to try to claim that, part of it is that you must have accounting systems that ensure all the transactions. You can be fined for having inadequate systems too. You can get both for that. Admitting that you didn't know and also for bribe itself. Okay, foreign-based DEF Corporation. Okay, so this is a foreign company, but they conduct business in the U.S. Okay, so they are under this act. The DEF employee pays a bribe of $110 to a government and customs official in the country of Alpha to allow shipments of goods to be offloaded from a cargo ship. The transaction is approved and recorded. Is this in violation? Oops, I lost my no. What do you think?
No,
Nope. This is that exception. It falls under the grease payments thing. I mean, it's called transaction payments, probably a better term for it. But no, that is one of those things. And notice that this isn't, them trying to get a contract that's usury or something for a government official. This is simply trying to get your stuff off the dock. And again, in a lot of these countries, you're also going up sometimes against what, is kind of traditional. I'll talk about that in a little bit. Okay. Uh, U.S. Corporation sells industrial goods to a private business located in the country of Alpha. The corporation gives the president of the private business a luxury automobile to secure a contract. Is this in violation of the Foreign Corrupt Practices Act? It's actually not. Why? Anyone?
because it's private.
Yeah, it's not a government. We're only talking about government officials. So the only thing we're looking at is if a government official is bribed. Now, the president of a company, I wouldn't call it a bribe necessarily. It depends on how much they own of the place. But if it's a private business, it is not on the Foreign Corrupt Practices Act because this is only for government officials. So it's a government official. If it's not a government official, if it's a non-governmental businesses, it's not covered. Do not whatever you want, but you know what I mean. Okay. A foreign-based foreign-based DEF corporation conducts business in the U.S. A DEF employee is coerced into paying a bribe to a government official in the country of Alpha to allow her family to leave the country. Is this in violation of Foreign Corrupt Practices Act? So they're holding their passports or something like that, and they won't let them leave. It goes up to this first line here. The bribe must be made voluntarily and intentionally. So is this in violation? What do you think?
No,
Nope. Coercion. If there's any coercion, that is not a part of the, that's that's not voluntary. So, yeah, and sometimes you hear in the news about companies paying ransom and things like that. Those are not, even if they're to government officials, those are generally not covered by the Foreign Corrupt Practices because that's coercion. You don't want to pay them; they're forced to. Okay. This one is also kind of to close up a little bit of a loophole. I should have done this. I should have bolded these before. I just did this handout. I just read it. Although in my defense, the first one it went through to convert it into a PDF and it ruined it. It ruined my original. I had to go back and do it. I had to make the PDF on an old computer. Okay. U.S.-based ABC Corporation has secured exclusive mining rights from the government of Alpha. ABC Corporation allowed Alpha government officials to attend a party that displayed several $1,000s worth of luxury goods. The luxury goods were missing after the party. ABC Corporation say they have no knowledge of what happened to the luxury goods. Is this transaction in violation of the Foreign Corrupt Practices Act?
Yes.
Yes, it is, and it could be on two different levels. First of all, this goes back to that deniability. They have no knowledge of what happened to the goods. Well, that's, every transaction is deemed to be that you do know. They can also get fined for not having adequate internal controls. That all asset transactions are authorized and I should underline this. All asset transactions are authorized and recorded. So these are asset transactions. The party, whatever, they have adequate internal controls over them, so they could actually get dinged twice. Okay. Big foreign corrupt practices cases. Goldman Sachs was by far the biggest one. The way this is written a little bit wacky. This 1.6 million is actually these two together, but then another 1.3 million. So this is a total close to $3 billion fine for Goldman Sachs, and a couple of people go to jail here over it. So these can be pretty serious, and they can be very convoluted too. It's crazy about how they try to cover it up and all that kind of stuff. But yeah, so that was the biggest one by far is Goldman Sachs. Ericsson. Ericsson's kind of funny, but not funny, but and this would be say 62 million. And bribes the leaders of anyway, so they're forced to pay a $520 million they knocked off the millions here. Oop. I'm gonna go back and correct it. So yeah, so here and looking at $1 billion worth of fines. And then they did it again. They kept doing it. They got caught breaching the terms. There's another 206 million. And one of the things that they often do for Foreign Corrupt Practices Acts are not only do they get fined, but they also have a thing that it sounds terrible, but disgorgement of earnings. And what they do is they say, okay, well, these contracts earned you 300 million or whatever. We're taking those and then we're going to fine you on top of it. So it isn't like they get to keep their ill-gotten gains, you know. So it isn't like a calculated thing like, oh, okay, we'll pay like, 40 million in fines, but we get to keep the 300 million in profits. A lot of times they usually go for disgorgement. They'll take all the profits and then they'll start fining on top of it. So it's pretty serious to get caught doing it. A lot of companies have gotten caught doing it. Walmart famously got caught doing it in Mexico and in India, where they went, and their whole thing was bribing officials to get stores put up. The local officials, they would bribe them to get stores put up, and that, you know. So anyway, so Foreign Corrupt Practices Act. A few ways it's controversial, at least two ways it's controversial. First of all, in other countries, they have very different cultures. And what we may see as something being corruption, they might be seeing as simply being, that's part of the culture. And they look at it more as homage. What do you do when you come into someone with authority? Well, you bring a gift. It's, and that's whether you're going to, your religious place, you bring tithing, or you go to, a government official, you show up with something. So a lot of times, that's kind of what they think, and it kind of goes along with that position. And that it's a normal practice. And in a lot of countries, they'll actually have kind of almost stated what their percentages are. Some are more than others to get stuff done in. Also, U.S. companies and companies that are doing business in the U.S. will say, look, somebody's going to make those payments because those government officials are not going to approve something without them. You're not going to approve something to you that they're going to give away where this other country will pay 30 million to us. And that all you're doing, it isn't like you're stopping corruption in those countries. All you're doing is the business is no longer going to the U.S. It's going to some other country, or someone else in the world is going to pay that and get that business. So there is it is somewhat controversial, and in the the foreign countries are saying, look, we don't have to do business the way the U.S. does. So they have that part, the cultural part, and then you also have the it's a global economy part that can't do. So it is somewhat controversial, but overall, I think it actually has had a really good impact, and that at least other countries are thinking about it, and that you don't get too much blowback from like European countries and Asian countries, and that for them doing business this way. That they want to stem that tide of corruption too. So I think overall it's been pretty good, and it has, I think, cleaned up some, maybe not all the way, obviously, but anyway. The importance to us, from simply a mechanical whatever point of view, is that companies are legally required to have adequate internal controls. It's a legal requirement. Before this act, if you wanted to have really terrible internal controls or no internal controls, you could do it. There'd be no problem with it. And if you say, I didn't know that was going on, you didn't know what was going on. You had a choice of what kind of controls you had. After this act, then it became serious. And you can actually get fined for it. Okay, this is similar to what we just talked about last week. I just kind of make it into a little bit more of a kind of a flow looking thing. I'm not going to go too far into this because this is what we did last week when we did the test controls. But basically, kind of like what we have here is a purchase request or requisition. And it goes to purchasing, like we talked about last week. They make a purchase order and they will send that purchase order will go down to accounts payable. A little bit more, a little further. There we go. Should probably back up a little bit. Okay. So the purchase order goes on to accounts payable. Hey, we ordered something. That purchase order will be sent to an approved vendor. The vendor will ship the paints to. Wait, I don't know how I did this. Oh, I'll put it there. The paints are shipped to the receiving department, so that's what they're going to do. And then the vendor invoice is sent to accounts payable. And the receiving report is also sent to accounts payable. And once we get all those together, we have all the documents. As an auditor, we're going to piece together all these things that go into making sure that the controls are in place, that all these three things happen, and then after that happens, then we'll make the payment from the accounts payable department, so that those will be approved when all these three things are matched up. And I'm not gonna get too far into it because we already did it. We did it last class, but anyway, this is kind of the flow of it. Kind of starts here and goes around and then comes back, and everything's matched up, then we'll make the payment. Okay. Incompatible duties. I think we talked about this already, but we're going to do it again. Incompatible duties are segregation of duties or duties that must be segregated. There's a few different terms for that, but they all mean the same thing. And we're going to have to go through some examples. And for internal control purposes, employees should only have one incompatible duties. If they have two, those are incompatible. So coming down here, looking at this, these are the incompatible duties. Remember it by car. Did we go over the incompatible duties? I think we did we? Custody of assets and authorizations. Record keeping. Did we do that? Okay, so these are the three things that must be separated. So if you are handling inventory, you should be making authorizations. Coming back up here, notice that the purchasing department does not get the inventory. The inventory goes to receiving department. This is one of those things that sometimes, someone from not accounting would question, well, why don't whoever ordered it should get it shipped to them, so they know what they got, you can't do it that way. So, the authorization would be, these would be like the purchasing department. There's other ones too, but. So this would be something like the purchasing department with the authorization. So they purchasing department would order it, they have authorization to order it. The inventory would go to receiving. Record keeping, that's only what we do in accounting. The accounts payable would be part of it, matching them up. And that would go into the accounts payable. Now we owe these people because we matched up. It's only an accounts payable when all these things, when all three of these match up. That's when it's an accounts payable. If it doesn't happen, then it's not 100% true. If they did ship something that wasn't matched up at the end of the period, you would go check and see what it was, and that we may have a liability there. But regardless, though, it's kind of keeping these things separated. Okay, so let's look at these. So Amy is a accounts receivable clerk. So this is an accounting position, right? Kind of walk through this first one together. So accounts receivable is here. So this is Amy has this. The mailroom delivers the customer's checks to Amy every morning. Okay, these checks are actually going to be a problem. Why? So Amy has the accounts receivable duties, the record keeping, but she's also getting the checks. What's wrong with that?
They need to be authorized by her?
Well, these are ones we're receiving from customers. So the customers send the checks to her. And why would this be a problem if where am I at here? Which one of these other two, what is a check? When someone sends you a check, what is it? What does it turn into, I guess? Maybe is a better way to say it. Yeah, I know, and by the way, these internal control things, this is hard. It really is. And even working in business, I can't tell you how many times in auditing, someone who has 20 years of experience, and I'd say, well, the controls over this are not what it is. They'd look at you and say, well, what do we do? They've been, 20 years, and it's strange, it doesn't necessarily occur to people what the problem is. But what's the problem? So Amy's has these checks. It actually fills into one of these blanks down here, or these other two, A or B. Checks are for what? Cash. So Amy has the accounts receivable, which is record keeping. Nothing wrong with that. That's what she should be doing. She should never get the checks. Checks are the cash. Notice what Amy could do. Now, we're not saying Amy did this, but Amy could take one of the checks and write off one of the accounts. Right? I mean, it certainly is a possibility that could happen is that um, someone says, you say, okay, well, what's you with the check? Well, perhaps someone left the check pay to blank. People do that. They'll have a stamp that they'll put on it. They'll leave it blank. They'll make it out to cash. You have all kinds of things that could happen that someone would take a look at that and say, well, okay, I'll just put my name in here, or get a bank account that has set it up in a similar name. Instead of Northwest Engineering, say Northwest Industries or something, and open up a bank account and put it in there. The bank looks at it and says, okay, well, this is Northwest whatever, takes money. So, and I don't know, I don't know if I told you or not, but we actually had um, the secretary to the plant manager in one of our um, facilities. I had an Navistar that did this for decades. Check would come in, and she had set up a bank account that was in a similar name, and I think she actually got an award for the longest serving employee before this. She had been I think she had been an employee for 45 years. But anyway, yeah. So that could happen. It could happen that you'd have somebody that, you have both of those things. Now, what she should be given is a checklist. Instead of this, what she should be given is a checklist. The mailroom should make a checklist instead of giving her. So she should be given a checklist instead of the actual, they list out the checks and give her a list of it. Then she can make it. And again, there's nothing to say that Amy's doing anything with that, but there is that possibility that it could be there. So she should keep doing the record keeping, but a checklist should be given instead of the actual checks. The checks should just go to the cashier. Cashier's dealing cash. So the cash should go right to the cashier, and the checklist goes with it. Okay. Bill. Bill is a customer service manager. And goes through all the returned merchandise to determine if any of them can be resold. Okay, so he has custody of the assets, either return merchandise. Where am I at? Here we go. Bill adds items to the inventory, adds items that can be resold into the inventory system and are sent to the sales floor. Bill enters items that cannot be sold in the system and are returned as scrapped. Bill actually has all three of these. Because he is determining whether they can be resold. Doesn't look like anyone is checking on that. Unsaleable items are disposed in the garbage, which in fact he has all of them. What could be the problem with Bill's incompatible duties? What could happen? Yeah, think like a criminal, like me. What could Bill do? So Bill's there every single day. People bring in stuff, and he goes through it. Says, "Okay, this can be resold. This can I'll enter it in the system. If it can be sold, scrapped." What could Bill do? By the way, I used to do this in auditing. It's around me. If I was that person, I'm bored with this job, 8, 9, whatever, 10 hours a day. And what can I do? Someone returns a nice watch to Bill. Well, Bill's a man or woman, but he could, so he's a man, so someone returns his watch and nice watch. What could Bill do? And by the way, because these are incompatible duties, it'd be very difficult to find it. Someone returns a really nice watch. They returned it because they didn't like the color. It was gold and they wanted a silver one. What could Bill do?
He could keep it.
And I mean, okay, so he keeps it. How would we cover it? You could definitely keep put in his pocket. And by the way, any employee could do that, right? I mean, so it's returned. He puts it in his pocket or wears it. Um, how is he going to cover his tracks? He could enter the system of being scrapped. It'd be very difficult to find. No one's looking for it. It's scrapped. And if someone were to confront Bill, throw it in the garbage. What's that you're wearing? My daughter bought this for me. Um, it's the biggest problem with these incompatible duties is not necessarily that you're going to keep somebody from stealing. Okay, know, Bill could go over to the jewelry counter, whatever, and stick a watch in his pocket and walk away, right? However, the problem with incompatible duties is very difficult to find because a lot of times they'll be able to cover, you know, all the documentation will be there that will cover for them so that you're not looking for it. You're not looking for this missing watch. It was scrapped. So that's the problem. If it was taken from the floor, it would still be on the books, and someone would say, "Well, where's this watch at?" And they start looking for where's that watch? What happened to it? If it's scrapped, no one's going to be looking for it. It's not going to be in the case, but it's not going to be in inventory either because you're going to see that somebody bought it and it was scrapped. Okay. And again, I want to say, well, I put something else in on these internal controls. Internal controls, when we talk about incompatible duties and if there's problems with internal control, like an internal control weakness, what we're talking about here, it doesn't necessarily mean anything bad has happened. It just means there's the possibility that it has or that it could happen. You know, Bill might be completely on the up and up. Bill doesn't do any of this kind of stuff. He takes his job very seriously. Anything that can be resold, he does. Anything that really can't be is those are the only things that he scraps. However, there is that possibility that it's there. Okay, so Kathy works in the Treasury Department. Kathy creates payroll checks every month and mails them to the employees. That is absolutely appropriate for Kathy to do. Kathy is writing checks, and she should be writing checks. People get mad if she doesn't. So she has the checks. Kathy does the bank reconciliation for payroll every month and sends it to accounting. This is a problem. It's a problem because the bank reconciliation has journal entries coming out of it. You do bank reconciliation, those things that you find that are wrong, you'll make correcting entries for those, right? For instance, you get a customer check comes back as NSF for $200, whatever. You make that journal entry, say, okay, we're going to take $200 out of cash and we're going to put it into accounts receivable and call up whoever gave us this check. So journal entries come out of that bank reconciliation. Because of that, time is it? Oh, I'm talking way too long. Because of that, it is an incompatible duty to have. His name Kathy? I forgot now. Kathy. So it's an incompatible duty to have Kathy actually doing the bank reconciliation. This is the bank reconciliation to be considered part of bookkeeping. This is why we have accounting people do the bank rec. Too many L's in there. So the bank reconciliation journal entries actually come out of that. So we would not want to have Kathy doing that. Kathy could manipulate the bank reconciliation to, dress up maybe an extra check she wrote, right? Now, there's nothing to say that Kathy did that. In fact, more than likely she did, but it is part of those incompatible duties. And so you gotta say, okay, well, all these, maybe Amy's fine, Bill's fine, Kathy's fine, there's no problem, okay, if they're not doing something crazy, well, why worry about it? There's two reasons why why you need to worry about it. First of all, there's a temptation thing. If you can't steal something, and get away with it, a lot of times you won't. You won't even enter your mind. If you do figure out, and remember, these are smart people, don't ever think that, oh, this person dropped out of high school, so they're not going to be very smart. You got geniuses that drop out of high school. So, if they're, and by the way, they're doing this every single day. They know this better than you and anyone else. So, to have that, there's a temptation. There's also the problem of if something bad does happen. Let's say inventory does show up missing, or cash shows up missing, or whatever. If there are controls in place, you can say, well, it can't be Kathy because Kathy doesn't do that. Kathy doesn't do the bank rec. If there's a problem with something, look at the bank rec. Kathy's not doing it. If there is, but if you don't have those controls, all of a sudden people who are innocent basically can become a suspect. And so it's not fair to them for two reasons. First of all, you're giving them an opportunity that they shouldn't have. And second of all, that you might leave them open for suspicion or maybe even losing their job because they have these incompatible duties. So there's two things, that are beyond just, hey, we're the auditors and we want people to, be limited what they can do. Okay, Dan is the accounts receivable clerk. Okay, I'm gonna let you guys figure this one out. There are incompatible duties. What are they? And what could Dan do? Okay, the first thing we got is accounts receivable clerk, just like Amy, I think, right? Yeah. Okay. Now Dan applies the payments based on a checklist. That's good. That's what you should be doing. You should have a checklist. So record keeping. That's absolutely fine. That's exactly what Dan should be doing. There is an incompatible duty here, though. What is it? Now, Dan's not getting the checks. He's getting a checklist. So it's not like he's getting the checks. It's not like with, Amy got the checks. Dan does not. It's a checklist. What incompatible duty, though, does Dan have? Anyone? Somebody. After this, we go on break. You got two choices: custody of assets or authorization. Flip a coin.
I think a B.
Yep, you're absolutely right. This is the incompatible duty. Writes off the accounts collectible. Notice, again, he doesn't have the checks, so he can't simply take the check. But what could he do? He could contact, he knows who these customers are. Maybe there's some people he knows, depending on the size of the town, he probably does know some of these people. Um, could make a deal with, someone on the outside and say, tell you what, I'll write off half of your, whatever amount they agree on, and we split it. Don't pay the company, $2,500, pay me $200 and I'll write it off. Now, again, Dan probably isn't doing that. Most of the time people don't. But if they are writing off, so the write-off should actually come from somebody other than Dan. If there is a problem with it, it should come from collections or something like that to write off an account. Dan should not be writing off the accounts. Okay, let's stop here. And we'll see. Be back at, oops, 7:10. Make it brighter. Make it bigger. Okay. Okay. Internal control audits. Okay, I'm going to put this in green. Wait a second. Here's a definition. I don't need this. And by the way, when we do our internal control audits, we're basically looking at this. Internal controls over reporting. This is all we do when we do internal control audits for businesses. We could do it over their operations and compliance, but generally speaking, as reporting, I guess a little bit of compliance might be in there. They have contracts and things. But for the most part, it's on reporting. Okay, so here's what happens. Financial audits are very common. Both issuers and non-issuers will get the financial. This is what we've been talking about this whole term, our financial audits. The dollar amounts, material misstatements, and all that. So those are every single thing we've done here has been pretty much focused on the financial statement audit, even looking at internal controls based on it. And so these are very common for issuers. We are required to have it. Non-issuers may be required by things like banks or loan agreements or something to have it. Now, there is a second audit that is required for publicly traded companies. This is for issuers. And that is the internal control audit. So this is for the financial statements. This one's for internal control. They're two separate things. Okay. So let's kind of take a look at what we're looking at here. So for financial statement audits, we test relevant control activities if we're relying on them. So if we rely on and you guys remember this from your sampling exam, we only need to test if we're relying on the controls. If we're not going to rely on the controls, we don't need to test. Doing the internal control audit, however, we need to test the controls every year. So, an internal control audit is a little bit different. Now, if it's a publicly traded company, you have to do the financial statement audit and the internal control audit together. They must be done together. So long story short, if you're auditing a publicly traded company, you're going to do test of controls over everything. And you're not upset about that because that's more money. Okay. Okay. The financial statement audit. There is no opinion over sort of the different, I don't know. I'll make this there's no opinion on internal controls. It'll say we looked at internal controls, but it's not part of our audit. Internal control audit is all on controls. It doesn't say anything about whether the financial statements are fairly presented. The opinion is on the internal control, and that's it. Timing, this is a big one. The timing of it is how else can I do this? Figure out a color that we could actually see. No, kind of, maybe. It'll make it green. How about? It doesn't work. We should get more colors. Look at these lousy colors. It's only three of them you can really use. These other ones you can't see. All right. Oh, I know. Uh, Give me a second here. Give me 2 seconds here. Oh, look at that. See? No. Okay. You're gonna. Oh, that looks terrible. Anyway, we'll just go with it. Um, Evaluate the effectiveness of internal control throughout the fiscal year. So this is all year long for. I inadvertently put the Green Bay Packer colors up there. Okay, so this is throughout the entire fiscal year. The internal control audit is only at year end. This is future oriented. So it's kind of like the timing. This is historical for the financial statement, looking back over the entire year. Whereas the internal control audit says, how are the controls at year end? That's all they're looking at is year end. All right, so it's sort of like this, if you think about the financial audit, let's say there's a problem with control early on in the year. Well, that could impact your financial statements, right? I mean, if you have a problem in January, let's say, or whatever of the year, that could impact the January sales or expenses or whatever. And even if it was corrected, you might still have a problem with the financial statements. So any internal control weakness throughout the year, even if it's corrected, could have a problem. The audit of internal control, though, is different. It says at the end of the year, going forward, do we have any problems? Whatever happened in the past happened in the past. Going forward, do we have any problems that we need to address in internal controls? So the fact that something happened in January, if it's not there at year end, if they corrected it, it's not part of the audit. At year end, what are the controls like? So the financial audit is historical in nature. What were the sales last year? What were the costs last year? What were the expenses and whatever? The internal control audit is future oriented. Tell the reader, look, what are the controls going forward? Whatever happened in the past happened in the past. Financial statements, they'll deal with whatever problems there were with that. But internal control going forward, is there anything they should be looking at? Okay. So let's go to A. A material internal control weakness was discovered by an issuer. May or may not need that, I don't know. On August 5th, no, we don't need it. It won't matter. The control weakness was eliminated on August 18th. Okay. Assuming the client has a year end December 31st, which audits would be affected by this event? Financial audit, the internal control audit, or both? You should also put it neither, but that's not an option actually. Which audits would be affected by this? The financial audit, dollar amounts throughout the year, or the internal control audit, which is at the end of the year, or both? I'll give you a clue. It's tempting to say both, but actually only one of them is going to worry about it. Which one? It's A or B. We're all friends here. Flip a coin. If you flip a coin, we'll get out quicker. Anyone? Yeah, are you guys sleeping? You guys are watching cats playing pianos on YouTube, aren't you? Which one of these is which one of these are we going to do? There's an internal control weakness in August. It was corrected in August, but it's going to show up in one of these audits. Which one? Anyone? All right, I'll leave it up to you. Test of controls are required for year-end audits of anyone? Okay, I'll let you guys worry about it. Okay. Control factors. This is one of those things that you're going to memorize for the CPA exam. You remember it by I.C. Hambo. I.C. Hambo. Integrity, management, commitment, competence, human resources, authority. This is authorizations. I can actually be more than that. Management philosophy, board of directors, how much they are input they have, and the organizational structure itself. Sometimes the organizational structure is not very good, and you would not have good internal controls based on. Okay. Control activities. You remember this as, we used to call it PIPs. They actually added one that's kind of redundant, but we'll talk about it. So it used to be PIPs, now it's PAPIs. And it's redundant because the new one is authorizations. Which is kind of odd because authorizations are actually part of the incompatible duties down here. But physical controls, these are locked doors, things like that. Keeping people physically away from stuff that they shouldn't be in. Authorizations, we already talked about that, authorizing transactions. Performance reviews, these are not performance reviews for employees. These are only performance reviews we're talking about, usually budgeting. Budgeting is probably the biggest one. Budgeting because, for instance, any large expenditure should be in a budget, and especially capital budgeting. So you get budgeting for, say, human resources and materials and all that, but also capital budgeting. This is for big stuff like property, plant, and equipment. And obviously information processing. Usually these will be the processing of, say, transaction. Actually have all these things, but I don't know, anyways. Information processing, how who has access to the information. Access, passwords, etc., stuff like that. And incompatible duties, we just did a whole bunch of stuff on those, so we're not going to do those again. Understanding internal controls, these are the same as we had before: inquiry, inspection, observation. Those are all part of getting an understanding of internal controls. Okay, documenting internal controls. 3 ways. Internal control questionnaire is the first one. Second one is a flow chart. Say internal control flow chart, probably a better way to say it. And the third one is an internal control written narrative. So these are the 3 ways we document. And we have examples of those. So example of an internal control questionnaire. So this is an internal control questionnaire. Was this for cash? Looks like payroll. Okay. So internal controls, generally speaking, on internal controls, yeses mean good and nos mean bad. That's not always the case, but it's generally if there's a control being done, it's a good thing. If there's not, it could be bad. You have to look into it. It might be covered by something else. But internal control questionnaires are yes/no questions. Again, these are internal controls, so yes/no is what you'd expect. So that's one way to document. You have an internal control questionnaire. They'll either be printed out, you can hand it to somebody, and they can go take it to people in the company, maybe the controller or assistant controller, and go through it with them. Flow chart. This is a flow chart example. It's a flow chart. It shows everything, how it flows. Remittance advice, customer checks, remittance, go on and on and on. Okay, so this is how it is, for the internal controls. Or visually, you get a visual thing. The little, and you actually you take the CPA exam, sometimes they have you do these little things, the little whatever you call that, upside down F triangle thing. Those are processes. These little wavy things are going to be documents. They could be electronic documents or they could be regular documents. The home base thing is off outside the company. Okay. Written narrative, just what it says. You write it up. So here's cash reconciliation. So you write it up and it just goes step by step how you go through it. Okay. Pros and cons. The pros of the internal control questionnaire. Administer it. Pros, anyone can administer it. Anyone can misspell it like I just did. The cons are that everyone knows that everyone knows that yes answers are the best. You might have someone who just says yes to everything because they know the game is if you say yes, you don't get any more questions on it. So sometimes you have to tweak the questionnaire to, allow for some no answers and make sure they're paying attention, make sure they're not just saying yes to everything and blah, blah, blah. Flow chart. Pros. Um, Experienced auditors can identify weaknesses very quickly. They're very fast. Cons. Anyone except experienced auditors will not be able to use it. So if you're not an experienced auditor, this isn't going to make any sense to you. If you put this in front of most people, their eyes are going to glaze over and it's not going to make any sense. So it's very difficult for the people. And certainly if you're trying to explain this to somebody, it's very difficult to explain it. Written narratives, pros, cons. Anyone can read it. So anyone can read the written narrative. So you can hand this to anybody. You can hand this to, the inventory clerk, and they will be able to look at it and read it and say, okay, yeah, this is right, or this isn't right, whatever. Cons, written narratives usually take a long time. So it usually takes a while, and it depends on how much time you have. I was in internal auditing, and in internal auditing, we had a lot more time than other people. So my whole thing was, and this is kind of I learned after it took me longer than I care to admit, but probably like a year and a half, maybe 2 years, um, that the written narrative for me was the way to go. I would just go through and just talk to people and get a feel for how they did things. I'd watch them, see what they did, and I'd write it all out and I'd hand it to them. And you could hand it to 5 different people and they'll read through and they go, oh yeah, yeah, yeah. Now, you know what? This one really isn't like this. We usually do this instead. And then you can get this very accurate, detailed document. Now, again, this takes a lot longer than most external auditors have, but I get this very detailed flow, or written narrative. And from that, I would make a flow chart. So I didn't do the flow chart till after I got this written narrative pretty much perfect. And then I would do the flow chart. And it's kind of funny because actually the external auditors, when they come in, they'll have their own flow charts and they'll look at it and go, oh, is this right? Yeah, that is right. Because, again, we're not any smarter than they are, but we have so much more time. If you have a week to do something, that's a lot different than if you have 4 hours to do it. Okay. Risk assessment. Maybe just a little bit more detailed now. At the assertion level, this is basically what we think about. These are the dollar amounts that we're looking at. Kind of this is what we usually think of when we think of risks. Potential for misstatements. How big can the misstatements be? What would they be? What accounts would they be in? All that kind of stuff. There is kind of an overall one that's at the not the account level, but the financial statement level. And this is getting into big things, management incompetence, board oversight. The board of directors doesn't know what's going on. Inadequate systems. These are things that could be, as for the financial statements as a whole. They could be going into bankruptcy. That has nothing to do with whether an account is off, usually, but these are risk factors for the whole thing. So you can read through those. Okay, relying on internal controls. Internal controls can have two different deficiencies. One is the design. Internal control design deficiency is when control will be an internal control deficiency is when a control. Yeah, give me 1 second. Oopsie daisy. So a control will be ineffective when used as designed. An operational deficiency internal control operational deficiency is when a control will be ineffective because it is not being used as designed. So an operational deficiency is the control is fine, but they're not using it correctly. So it's not being used as it's designed. And I think I talked about I think I talked about when I was like a kid that I was working in a bicycle shop, working the cash register. Did I already tell you guys this? My boring stories. Okay, I'll quickly go through it. I got a job when I was 14 working in a bicycle shop. I don't know if you can do that anymore, but anyway, I worked in a bicycle shop when I was like 14, and I was hired along with two other 14-year-olds. What could possibly go wrong? And they put us on the cash registers. Okay, so they had these three cash registers, and for the most part, we were assigned one, but these were kind of older cash registers, and sometimes they didn't print out very well. And so sometimes we print up a receipt, the customer would say, "Oh, I can't read it." So you go over to the next cash register and you ring it up again. You already see where the wheels have come off this. That we didn't realize that what people were giving us, had to go in the cash register, and that it was the register was actually keeping track of everything that should be. So and it was very common that there's tape registers, tape runs out. Well, like we're 14, and who knows how to replace the tape register tape in a you know in a cash register? None of us do. We're 14-year-old kids. So anyway, uh, it looked like a bunch of things were being stolen, like a bunch of money was being stolen. Like, oh man, we had all these sales, but all the money's stolen, right? And of course, 14-year-old kids working a cash register, coming to it, and none of us realized that. Like, well, I didn't take any money. Going around. Anyway, so that was an operational one. We didn't understand that it's keeping track of it. And it was kind of funny because one of the owner, one of the owners was there. It was like a big sit down meeting a couple weeks into or after our hiring, and one of the owners said, "Listen, how come these are being rung up like 30 seconds apart on two different registers? There's a whole bunch of transactions that are like this that are like 30 seconds apart." And it's like, oh well, it didn't print out well, so we went over there. Like, oh my god. So anyway, the long story short though, it was ineffective, and someone could have been stealing money at that point because no one really knew. The controls had failed because we didn't realize that you can't do that. So if something doesn't ring up, what do? You handwrite the receipt. You don't, go back and ring it up on another register. Okay. How much farther do we have to go? Not too much farther. We'll see. Yeah. And something tells me we're not going to get to all this. Okay, well, we'll go through this anyways. Testing of controls relating to risks. How to perform test of controls for all the following except, do you guys want to take a crack at this? You want me to leave them? No? All right. I'll put these. I'll put these in. We'll call it a day after this. They perform it for all of them except for A. We do not, it's not that we don't care whether the controls are efficient, but we're more worried if they are effective and that they either detect or prevent material misstatements. So the efficiency is not one that we are terribly concerned about. We might let the client know if they are doing something very inefficiently, but more, we want them to be effective. Which the following audit procedures would be the least useful for evaluating the effectiveness of internal control? It's going to be B. And it's going to be B because this isn't necessarily how they're doing it. You want to ask the employees, see how they're doing it. Go through the, oh, capitals. Go through the controls themselves. If they're doing that. I don't know, wait, was that misspelled? Be a bust. Nope. All right. So you work through the controls yourself. That this is probably of these, this might be one of the best because it's actually when you're doing it. So this is this one and E would probably be the best of the two. Or let's say better. Reperformance, do it yourself. Inspection of documents and reports. Again, this is there's nothing wrong with it. It's just it is sort of secondhand. It's somebody else that has done it. This isn't your work. This is somebody else's work. And observation of calls. This is one of the better ones too, because it's actually you are observing them. And again, observation was a huge one when I was doing auditing. I don't know if it still is, but it was absolutely huge because a lot of times people would tell you something and you'd go and watch it and it had nothing to do with what they were actually doing, or very little to do with it. So these two are probably the better of the, these ones here. Because it's your own work, and which is more persuasive. And test of controls will allow the auditor to complete all of the following except that one. You cannot rely solely on internal controls for the audit. You must do some dollar testing, substantive testing. How do I say that? I'll put it underneath it. Substantive testing, things like classical sampling and that kind of stuff. So you can't rely purely on internal controls. And you might be saying, well, why is that a rule? Well, it's a rule because there actually was a problem around the time of the Enron case. There were auditors that were saying that we should only do the test of controls because if the controls are working, then the dollar amounts will be fine. So if you really test the daylights out of the internal controls, you don't have to do anything else. And we found out that that was really not the way to do it. One of the problems with it. So auditors must complete substantive testing. Internal control testing is optional. Okay, let's stop here. Yeah, we'll get this done. We'll get that, next time we'll do this and a little bit of chapter 16, and that'll be the final test. So let's go back to this. I'm going to combine with the end of audit procedures. We'll combine those. And I want to do one more thing here. Oh, yep. And that is that late work is accepted the last day of the term without penalty, so you can turn it in and get full credit. And your graded date will be updated after you turn in the late assignment. So if you haven't turned in something, don't think, oh, it's past the date, that you can't turn it in. Yes, you can. And you get full credit for it. So don't think that you can't turn it in. No one is failing this class as of yet. Okay, you can always turn in late work. We'll take it whenever. And I'll tell you why I do that. On the syllabus, we have all these objectives. And quite honestly, I mean, does it matter when you do the objectives? You know, if you do them sometime during the term, you know, whether you did it the first week or the last week, doesn't make too much difference if you actually look at the syllabus. So that's why I take everything right up to the end, because it's like, you know, if you do it and you show that you know, met that objective, then good enough for me. So you can always turn anything in all the way up to the end of the term. So no one is failing this class. And if you are missing something, feel free to turn it in. I'll gladly take it. Any questions? No class next. Oh, let me put that down. Hold on one more time here. Next week, we do not have class. No class next. We'll put that right at the top. How about in big obnoxious capital letters? That's fall break or barar, I like to call it. Okay, let's call it fall break. So no class next week. Okay, all right. Uh, and with that, see you in 2 weeks.